Hey everyone, how's it going? So today we're going to do a stock review of a UAE stock. Now this is a bit different than usual and I'm excited to go into a local stock. So let's get into it. So the stock is ADNOC Gas, all right? Now before we go into this, I want to say a few things. I never buy UAE stocks ever at all, and it's not for the reason you think. So I own property here, I work here, my family's here. So I'm all in on UAE. So when I buy assets, I try to diversify. I usually buy American or Japanese stocks. But today, because this stock has come up, it's a very interesting stock. It has a few things I'm going to talk about today that make it very special. I think it's a good opportunity to get in on it. And I also think for those of you who aren't living in the UAE, there's some good opportunities here. Maybe you guys would like this stock. So first we're going to go through this article, which is the one that got me interested in to look at this stock. So the article, if you look at it, it says that 15 leading financial institutions reiterate to buy or accumulate ADNOC Gas stock. All right, that's a very interesting point. So this is a stock traded on the Abu Dhabi Securities Exchange since March 13th, 2023, and we're going to look into it. So JP Morgan, Goldman Sachs, Morgan Stanley, and other Wall Street companies, banks, 17 covering brokers, they provide a buy rating. Now, before we get too excited, these are the biggest institutions, but that being said, they have no skin in the game. It's kind of normalized that they should provide a rating for every single, equity out there. So the truth is, if you buy and it goes up, then actually you're not, they're going to claim they helped you. And if it goes down, they're going to say, it's your fault for taking free advice in the financial world. It's kind of crazy that they give this advice. So I have a CFA level 1 and there's an ethics component, and it's the financial advice is highly regulated. And if I was to give you financial advice, for example, I would be required to be licensed, and there's certain requirements. But JP Morgan can just, give a buy recommendation to the whole world, and that's fine. So there's a bit of a problem here. The other thing is, we're going to review this now. We're going to decide if we agree if it's a buy. If we agree it's a buy and they agree it's a buy, that's not as worthwhile to buy it. The best cases are where you disagree with the establishment, where you've done a bit more work and you've really thought about it, and you have let's say dissenting opinion. Then the opportunity to make money is bigger, because let's say it's a buy right now, everyone wants to buy it. That's great, but if the price tanks, everyone's gonna get scared because they only bought it because it was a buy recommendation. If the stock does well, a lot of people are already in it already, so how much better can it do? And a lot of people will sell early. So if it's a sell recommendation, the price goes down, the people who do hold are more serious believers. Anyway, let's continue with the article. 15 regional institutions say buy. They say the company has robust fundamentals, disciplined capital deployment, long-term growth visibility. Okay, we're going to look at this. Let's get a bit in the numbers. Q2 2025, they got 1.385 billion, 16% year up. Now, the net income is a big factor here. We're going to talk about when we look at their financial statements, but you'll see the net income is rising for this company, which means you'll see they make the same revenue, but their profitability is higher, which is very important. And their earning before interest, tax, depreciation, amortization is 2.256 million, or 8% year on year up. Now you can see a huge amount of their funds goes to tax and depreciation and amortization. You can guess why. It's a capital intensive business. So they have a lot of capital deployed, which of course depreciates substantially. Okay, so JP Morgan says they beat the estimates substantially. I don't know how they beat the 2026 estimates in 2025, but we'll find out about that. So they've got a price target of 4.33. I should have showed you this first. Here's the stock price, stock ticker. This is the full chart from when they started, March 13, 2023 to today. Now, we should have started with this because if the graph doesn't look good, we're not going to buy under any conditions, right? But the graph here looks good. It's been trading sideways, trending upwards, honestly, but the volatility is so large, you know, relative to its price movement. It's still trading within its band, you know? So if we think the stock is going to take off, then now's a good time to buy, I would say, if we agree. So the price we have is 3.31. Let's get the calculator out. All right, I did this already. 3.31, and JP Morgan's price is 4.33. So if we go back to the calculator, we're going to do 4.33 divided by 3.31, which is going to give us roughly 31%. So JP Morgan estimates a 31% increase in the value of this stock over the next 12 months. And I will get into why I think that's reasonable and understandable. Let's see. They offer Goldman says goodbye because of play on the energy theme in UAE, offering attractive combination of growth and yield. Now, this is actually part that's going to get very interesting because this company actually pays dividends. Now, let me find out where they are. It's 5% dividends actually, which is substantial. Let me find where is that. So let's go into this. Anyway, we'll come back to that. Environment added the updated guidance to recommend concern margin impact of low oil price. Okay, Kepler Chevreux upgrades estimate earning per share from 8% and 2% for the outer years based on the stronger than expected domestic gas business. The economy is growing really well in the UAE and they sell gas to the economy. Okay. Doesn't mention their dividend yield here. Okay, that's fine. In the other pages it does. So something I want to talk about is the concept of dividends. So most of you, if you've been investing the last few years, you don't pick dividend stocks. Dividend stocks are categorically a loser stock. And the reason why is very simple. Back in the day, dividends were used a lot. Dividends are fantastic because you can own a company and get rent effectively, some kind of rent, share of the revenue, share of the profit on a regular basis that allows you to de-risk your investment because you're betting partly on the revenue, on the pure income, and then partly on the growth of the value of the stock. Unfortunately, in the West, there's this big Uncle Sam likes to get in between you and your investments. So when the government decided to tax dividends, they did so in a way that makes paying out to your shareholders dividends inefficient. And so people don't do it anymore. Instead, they do share buybacks, they reinvest the money, they do all this kind of other stuff to try and drive up the stock price. I'm not a finance, let's say, PhD or a doctorate, so I won't talk about the real impact of that. But suffice to say, stocks that pay dividends in the US tend to be underperformers. And people still buy them, and there's a whole subreddit of dividend stocks because it is actually probably unhealthy to put so much of the outcome of your investment on your entry and exit point. That's the problem with growth stocks. Your entry and exit determine your profitability, not the holding period. Actually, you could get it wrong by a few months and lose all your profit. And that's what's very unfortunate. Whereas dividend stocks are very stable. So people who buy them are more relaxed because they know their income and then they have a hope of a growth, but less growth. So ADNOC distribution, ADNOC Gas in this case, and also ADNOC Distribution, which is another fantastic ADNOC company, they pay dividends. And the reason you can get dividend paying companies in the UAE is because we do not tax capital gains. So the beautiful financial institution of dividend paying public companies is basically penalized in other markets and is not in the UAE. And so we have a greater propensity for companies to do that because it's nicer as an investment. Better to get your money out. You can rebuy more stock or you can buy some other asset. But when your money is all tied into the growth, it's a different game, you know? It probably helps banks a bit more because they can take the risk better. You know, they have like high frequency trading. They have like ways to play around that. So, okay, let's look a bit further in this article. They're just saying that the analysts value them highly. They have a strong domestic base, capex pipeline position. All right. So looks good. They look to grow. Let's look a bit further. The stock, we now have agreed. We looked at it a little bit, but we can see it trended up, reached quite a high point. So it's definitely been higher than its current point. Then it went down, suffered for about a year before coming back up. I don't know what happened this year between February and April. Could this be something to do with the conflict? Maybe. I don't know exactly what caused it to fall, but it fell pretty sharply. And it's making a very good recovery. It's not even that expensive to buy. If we try and look on a shorter interval here, have the full chart. No, I don't want that. No. Okay, here's a bit more chart. How do we get... Okay, this is a more daily chart. It's even on a low today, so today is not a bad time to buy. You have 4 red candles, 1 green, 2 red. I don't know who's a technical trader here. You tell me, is that a good sign? But we have a lot of red candles in the past, so we have to see. If you're a technical trader, you can do your analysis, but I'm more of a value investor, so I don't particularly mind my entry as long as it's close to the mean. Like now, like imagine if you're buying in this period of time. If you're buying between February and April, it was quite a hectic time, but now it seems to be steadily growing. All right, we'll go to the reports. So I actually marked this page in their financial report. So they have 10 BSCFD, which would be billion square cubic feet per day. So that's like a capacity of the size of their site. 6 million tons per annum of liquefied natural gas pipelines, and they pretty much meet 60% of the UAE gas requirements. My guess would be the other Emirates maybe would be less reliant. But I really wanted to get in here so we can talk about the company. We want to talk about their financials. And I have their profit and loss here we'll get to later. So they're an integrated gas processing company, a subsidiary of ADNOC. Okay? So what they do, as far as I understand, is they receive gas through pipeline and then liquefied natural gas from different countries, different suppliers, and then they sell liquefied natural gas, and so they must receive the raw gas. Okay, so this section cut. What they do is they receive the raw gas and then they turn it into liquid gas for shipping. Looks like to Japan here, Germany, India, or then they supply Bahrain and Kuwait, maybe by pipeline. And then they cylinderize it here and sell it in the domestic market. I buy gas actually from ADNOC Gas, and in my old building we used to get from Royal Gas, which probably buy their gas from these guys and distribute it to their real estate assets. Okay, let's look more about this. Highly integrated and comprehensive gas management platform. Okay, so the main thing to understand here is this is what we call an infrastructure company. They receive a raw material, they produce a commercial grade material. So usually they have a license to print money, and the way they do is they arbitrage loans from the bank. So they borrow money, build this huge infrastructure, have a guaranteed supply and a guaranteed customer. The big risks in these kind of companies is supply shock. Given their suppliers ADNOC, I don't think they're a big risk. And given their customers are all the top tier oil distributors, I think they're probably very good in terms of customers. They started in the 70s, but they went public in 2023. Okay. Well, this is more of a history of their natural gas shipments. And I guess it's the history of ADNOC's involvement in the gas industry. Okay, these are very high level figures, which I don't think are very informative. Okay. Let's look at what they've done this year. 10-year supply for India, increased net income, dividends. Oh, yes, they have a mention here of their dividend yield, which is very important. This, of course, is the CEO, Dr. Sultan Jabbar. He is very well-known individual, minister, and all his companies have been successful. So that's, some people like to look at the leadership team. Alhamdulillah, fil Imarat, with ADNOC, you know the leadership is pretty good. They are running one of the most successful companies in the world, and they know this business very well. My father was a chemical engineer. Pretty much every Emirati has some background experience in the oil and gas field. It's the GCC, you know. This is our business. This is what we excel in. I'm looking at all this. This is all great, but I'll be honest with you. When I show you the financials, I think a lot of this is too technical for me to appreciate. And really what I want to look at is the trend here. So this is their Q1 results. So this is their yearly results for 2024. This is their Q1 results. I want to see what they paid out in dividends, or they paid in Q2, I think. Is their pricing, performance overview, ADTV million shares, average date. Okay, this is more like their financial performance as a stock. We know it's a good stock. It's quite robust. It's maintained this price. They paid their dividends. 5% year domestic gas EBITDA growth in Q1. Okay. Yeah, LNG is going to continue to be cheap as the US has the kill switch on the price with their fracking. And eventually they will get all the gas out of Mozambique and all those other crazy places, which they do have insane pockets of gas. Okay. They don't mention their payouts. Shareholder, okay, let's see. The 86% of the shares are owned by ADNOC, so that's a pretty good thing. ADNOC National Energy Company owns 5%. I'm not quite sure what that is. Okay. Gas ESOP. Don't know what that is either. So actually only 8 or 9% of the shares are free floating. So I think when you look at it like that, oh, TAQA. Okay, ADNOC National Energy Company is TAQA. So TAQA is actually the distributor for energy in the UAE. So they probably buy the gas and burn it for electricity. So that's why they own a share here. They're probably the biggest customer too. Because if you don't know, the most efficient fuel to burn for power generation with the least carbon footprint is natural gas. Because you have methane, which is 1 carbon with 4 hydrogen, and it causes less CO2 when you break those bonds and you form, like, I don't know, some other CO2 and hydrogen. And if you have long chains, it just creates more CO and CO2, okay? For the same energy. So natural gas is the most efficient one to break there. Okay, I think this is great, but we want to get in. Okay, we'll come back to this management discussion analysis report. Let's look at the numbers, because I did look at these earlier. Okay, so we want to go to their production. These are the numbers I like. The asset utilization, you see, was quite high, 85, trending higher, and then it dipped. And I was wondering why. It's because the availability dipped. So something happened last year where the availability dipped substantially, and so their utilization. But it is worth noting, they lost about 7.3% of their asset availability, and they only lost about 6% of their utilization. So that means they responded well to the crisis, whatever the crisis happens to be. Maybe some repair, some annual. It doesn't have to be a crisis; it could be planned. But their liabilities stayed high, and then in this year you have again similar situation, but not quite as good here. They did something which lowered their availability, but the utilization tanked. It's the lowest it's ever been. So that is worrying. The other good thing to find here is, let me find the statement. Profitability by product. No, we want to. Okay, here you go. So if you look here, the revenue is pretty consistent. Now we did see a drop here, but we also seen the availability drop here. So we're not sure what caused that. But the revenue seems pretty consistent year on year. The earnings changes. So you see, there's a few things that are happening, but their operating expenditures trending downwards almost continuously over time. Their minimum gas payments are pretty stable, I would say. And this is also stable, though sometimes it does vary a lot. So what you're seeing, I think also the earnings before interest and tax. Okay. The taxes seem to be declining, maybe. Oh, well, let's see, the decline in taxes comes with the decline in production, right? Because the taxes are probably tied to the volume. So maybe the actual increasing profitability is really a function of that decreased production. This is something that we really want to see. What is the net income margin? And that seems to be quite healthy and increasing over time. And especially the earnings before interest margin. So it's staying healthy. It's above 30%. You know, it's quite strong. And if they continue the same way, they continue to implement efficiencies over the company, you should see them increase their net income. I don't think they can increase their revenue. And the reason why is if you take this time period, 6,000, their production is close to, well, they never really hit fully 90% utilization. So they do have actually, I changed my opinion there, they do have a chance to increase their revenue by almost 10%. So they could potentially increase their revenue by 10%. Taxes scale with it, but if they can do it efficiently, they could increase the pie and also simultaneously become more efficient. Now, I think we're going to look a little bit at this final report, and I think then we'll call it a day. Okay, we'll have a wrap up. Net income of 2.7 billion, almost 37% margin. Asset reliability reached 98.7%. So I'm not sure what's in utilization reliability. Let's have a look. I know what utilization is, but what does reliability mean? So I mean, I guess that's like their site is ready, but it's just not being used, which I guess is their top numbers. They're leading with that. Revenue, cost of operations, goods and services. I want to see what they paid out in dividends. I think that's a big one. I had that numbers. Okay. Dividend policy. Okay. This is what we've been looking for. This one, the big one, the most important. Let's get paid. Our dividend policy remains subject to factors such as distributed revenue and future profits. So they say this because of a disclaimer. But when you have a factory that produces a commodity and your shareholder is the company that makes the raw good, I think this company is going to be very rock solid in terms of their reliability. I think whatever numbers they put, they're pretty much never going to go down. And I can't see gas growing in cost or decreasing substantially in cost, because I think between the GCC or OPEC and the US and Russia, they've kind of fixed oil prices. That's my opinion, and probably everyone out there is like totally wrong. But anyone who thinks they can guess the oil market or predict the oil market, he's a liar. It's impossible. Too many variables. I'll give you an example. Who's that guy with the big... Ray Dalio. Ray Dalio, I think, used to pay satellites to give him images of the tank level in Rotterdam so he could see how much fuel was being traded per day. And the velocity of the fuel, basically the velocity of money, like how fast it's transacting. And that would help them to trade the market, but I don't have such resources, let's say. All right, so they want to grow the dividend per annum 5%. And that's a commitment. So that's interesting, a growing dividend. 5th of August, entitlement date. So they give two, they're similar to ADNOC Distribution. ADNOC Distribution is another dividend paying company. I used to have their stocks, but I sold out because I wanted to be in US stocks at that moment. So they pay twice a year a dividend of $1.79 billion. Now, how much was their revenue in that period? Their net profit, net income was 2.4. Okay. So they're paying about half the money, probably half their income in that, and they're probably carrying forward, making investments with the other. So we're expecting them to grow the dividend there. All right. So this was very important to me. Let's just have a quick look, because I had these dividend per share of ADNOC Gas. Let's just have a look at it. So they pay 9 fils per share. Okay, dividend yield is 5%. So roughly, whatever the share price is, they try to pay 5% of that. So what does that mean? If you put $100, let's try to review the stock, right? So from the top, excellent supplier, excellent company structure, very good leadership team, excellent market. They have a very simple business model. They buy raw gas, they sell commercial grade gas, sell to international clients, domestic clients, and they have a facility which does the processing. They're almost maxing out their capacity, but they have excess capacity which could drive their revenue and their profitability. Profitability is not going to be driven by that. That'll be driven by changes they make to their company, which we would think, ADNOC being a leading company, would be able to innovate and integrate other innovations as they go over the years. That's why they have a progressive increasing dividend by increasing it 5% per year. Now they're paying 9 fils per share. So 5% of that is, I don't know, like 9.45 fils, 9.45 fils, and the next year it'll go, fils is 1 cent from a dirham. So if you're not familiar with our currency, there's 100 fils in 1 dirham. 9 fils is about $2, 2 cents, 2.3 cents, 2.2 cents maybe. Let me get the calculator out again. 0.00. 0.09 divided by 3.67. Yeah, about 2.5 cents. Okay. So if the price of the stock is $3.31 today, and you're going to get 9 cents per dividend and 2 dividends per year. So for each stock, you're going to get 18 fils per year, increasing. So it'll be 18 this year. So you'll get 18 cents per year, and you expect that if we take JP Morgan's advice, we'll get an increase from 3.31 to, what was their target, 4.33? 4.33. So you'll increase your, for every 3.31 dirham you put in, okay, you will gain 1.02 of profit and 0.18 of dividends. So 1.20. So if we do, I need to get the calculator out. Closed it. So if we do the math, 1.2 divided by 3.31, as it stands today, you're looking at 36% profitability. Now, that is pretty crazy. So if you put 1 million dirham in this stock, you'll expect 1,360,000 dirham next year. And you expect your stock itself will be worth 1,300,000. You'll get about 60,000, something like 60,000 in revenue. Let's do this. I can tell you exactly. 0.18 divided by 1.2 times by, okay, you get 150,000 15%. Okay, so 15%. So 1.360 times by 0.15, you get 200,000. You get about 200,000 in dividends, and the other 16%. Is that right? No, that can't be right. Oh, because I'm doing the whole amount. Okay. Sorry guys, my math is not mathing right now. So you're 18 over 0.18 divided by 1. I'm not. This calculator's not playing. 0.18 divided by 1.2. We know it's 15. We just did this. 15%. So 15% of the 360. Okay, because we got 36% as a profit margin, is going to be, so 360 times by 0.15, we get 54,000. So I was very close actually. I was more accurate the first time. So you get about 300,000 equity growth and about 60,000 in dividend shares paid out to you. And actually, because you'll be in the next reporting period, you would expect to get a bit more, closer to 60,000, because they're supposed to increase the dividends. And I think, to be honest, given that the company has secured almost monopoly market and an extremely reliable supplier, the chance that this is a sell, the chance that this loses money, the fact that your stock will go down a lot, is quite low. The only thing I would say is this stock is a very stable, reliable stock. If you're maybe a bit older, you have a bunch of money, I don't want to say, like, again, this is not financial advice, but it is imperative that I mention that who you are matters. So if you're an older person, mid-career person, even late 30s, not quite old, still a very young person, but you're looking at stashing money away for retirement, this is the kind of equity that I would recommend. It's consistent, it's going to pay you money all the time. You can use that money to pay down a mortgage or other financial obligations you have. The value of the stock will grow over time. It should. It has every possibility to do that. The markets will keep growing. They have the capital to reinvest. They have a good environment, a low tax environment, so they're likely to keep growing. If you're a younger guy and you're like 20, this could also be a good one for you to put a big chunk of your money in to just stay and grow consistently over the years. But you do want to have more aggressive, more like Amazon type stocks. You want to get Microsoft, also very techy stuff. So it depends on your personality. Like Warren Buffett, as you know, never bought a tech stock until he bought Apple, and he was investing for, I don't know, he's 95 or something like that. So that was very recent. So you don't even need to buy tech stocks to get rich. If you don't want to get rich, you're trying to retire, you want a consistent income that you can rely on, or you don't want your actual wealth to be lost, I would say dividend stocks in the UAE are good. ADNOC is a good company, and they're allowing people to have a piece of the pie, albeit only less than 9% is available for the public. But it is a chance to get in on it, and the purpose of public markets is to democratize wealth and to allow everyone to have a piece of the infrastructure they live in. Thank you very much. Hope you enjoyed my analysis, and see you all later.